point, Gary called me and asked me, he goes, hey, would you speak with me about some of the trends in the market? So if you're not familiar with RTO National, we're 20 years old this year, and we do have a footprint that covers from Maine to California. So we are, all standard measures, the largest generator of finance payments contracts in the shed and carport industry in the United States and contiguous U.S. So a lot of the data you're going to see is just things that we gather in our day-to-day operations of our business, but wanted to look more to the points that came up in the survey of what people were talking about, concerned and interested in, and then the conversations and phone calls that I got. So we're going to kind of start out with like 21 versus 22. So the orange line is 21, the black line is 2022, and you're looking at unit sales and the growth year over year. And some of the things when people are going, how do I get the data and look at these things, what am I seeing? So, February has always got seasonality in it, but if you look at the year, carport and shed combined, and I do use the term carport kind of loosely, that is the carport steel structures industry, kind of this familiar one that we all have that sell from shed lots, and then sheds would be both metal and wood LP sheds. But you see there was last spring, there was actually a small dip that said 22 did not perform as well as 21 in just unit sales. I'm not measuring gross dollars. There's a lot of fuzziness when you start measuring gross dollars because of the fluctuation in pricing that kind of rolled into the market. So we kept it to units. And then you see that as the end of the year came, you do see, and I very much agree with Gary when you look at the survey, people said I had a better year in 22 than 21, and 21 was a great year, but most people started, the conversations I was having with dealers and manufacturers across the country is it's getting tighter. You can feel it. You can feel the recession coming in, and you're starting to see that show up in the data. You'll see pieces of it come across, and you can see the margin between the two in just raw unit sales. So some of the things, this is just sheds. So sheds tells a little bit of a different story. Sheds has a more pronounced change from spring. Spring of last year, 2022, did not perform. Now, and I've got a great, hopefully there's some good Q&A, and I'm like Gary, I'll be around both days and healthily talk to anybody who wants to talk to just how we look at the data. Some of this I do kind of attest to inventory. A lot of people had come out of 2020 with almost no inventory, had started ramping into 2021. We had done our best to build as many buildings as we could, and when the spring market hit, our inventories did not sustain the previous sales. But the minute I say that, I go, but yeah, we didn't have any inventory in 21 either. We actually had more inventory on the ground in 22 than 21, so it does appear there was a fluctuation in year over year. Some of that could be a return to some more seasonality. The most interesting, recently is October. There's a single spike that the year over year sales are not showing growth. And that's even consistent with the information we got from our partners in Contract Flow. There was a nice little pop in December. I do see people saw a little bit of an experience, in December that said it was different. But now let's look at carport. Carport's very different. I was looking, we've got a partner I talked to the other day, that's a carport manufacturer. And he's going, what's going on? January has opened up just super slow. We'll just look at the black line. Year over year sales in carport and steel structures have been substantially higher. Some of that was availability of product. In the steel structures industry, availability of labor just to get to the market. But you started seeing the two lines tighten tremendously in the end of the year. It is our belief January could actually see an axis. That you will see year over year growth have slowed to a point that carport and steel structures could be experiencing a downturn. So let's look at just kind of some of the things that we're seeing overall. A lot of this is way more specific to shed because the square footage measurements on carport is not nearly as indicative. But when you look at the blue lines, this is the increase in pricing. We found people, and I shrunk it down, one of our data teams actually here, and it's like, yeah, I appreciate it, I almost got time to put it in. But this goes back to 2011. So you kind of see the rapid rate that prices in sheds started changing when you got into 20 and 21. But you look at the orange line and you're looking at price per square foot. The greater chart, you look at it and go, oh yeah, Richard, you're not telling us anything we didn't know. Prices went up, price per square foot went up. But most people weren't paying attention right here. You're seeing a decline in price per square foot. You're seeing a somewhat decline in pricing. Retail prices have stabilized and they're flatlining. They're showing the first signs of starting to decline.
The sheds came up to a line. We do not expect them over the next 2 years to decline substantially, but you're sitting in that over 6,000 as an average shed. Keep in mind, you step back as early as 2020 and you're talking about a $3,600 shed. When you look at average square footage versus retail price, this uptick right here. So retail price went up. We saw 22. Price increases went in. Material prices went in. Sales have maintained. But now you're seeing an uptick in average square footage versus retail price. What are we selling? It's screaming we're selling a bigger building. And very recently we're selling a bigger building. If average square foot continues to increase, trending higher as prices declining, the average shed for a long period of time is set as a 10 by 16. I know the manufacturers in the room look at me and go, yep, 10 by 16s make sense because they're more efficient from the size of paneling and things like that from a build. If you just take the data in this window, as our prices went up, the average building increased in size to a 10 by 20. Now granted, I know that could be a 12 by 18 or whatever you want to break it down to, but in square footage, it's still a 10 by 20 building. So you saw the prices go up, but you saw the buildings go up in size. When you get to average square footage and average price per square foot though, the current downward trend in pricing and price per square foot with the increase in average square footage is screaming that even recently in the last 60, 90 days, we're seeing an increase in the size of the average building. But we're seeing a decrease in the average price. There's a couple of hypotheses that go, and I didn't put the data up for this. It is our current opinion at RTO National, there is more complete, what we call stock or idle inventory sitting on the ground in the United States on shed lots than quite possibly and than ever in the history of the business. There is more completed for available sale buildings than have existed, definitely within the last 10 years. If you see this uptick in building size and you see a downtick in price and we're heading into the spring selling season and you know there's a bunch of inventory on the ground, the supposition comes to people are starting to discount big buildings. Big buildings sell slower on average. All the data screams it. They are the better profit makers as an industry, but they're the most expensive. So you're seeing the first signs of discounting, and you're very likely seeing the first signs of heavy discounting around large buildings. I keep getting, have you seen the consumer back up in what payment they're willing to pay yet? We have not. The payments walked up with the price and the consumers have stayed right there with it. But what we're starting to see is, and I can't answer the question, I can only pose the data that says, is it being driven by the seller that's saying I need to turn inventory before spring does, or I'm trying to turn out different, or is it just the fact that consumers going, I want a bigger building with fewer options? It's possible that's the case. We've just not ever seen that type of behavior before. Now, I know I'm holding right into this range. You see it again, it happened in September. And again, you talk about September, you're heading into the last big selling month of the traditional shed season of October. And you're seeing increases in average square footage, but you're seeing a decline in average pricing. So it's showing the indications that we may be seeing the first real evident signs of national scale price discounting. The next few slides, I just kind of hit it. I get asked this a lot, and I know some of this data is just not always easy to get to, so I just kind of put it in the slide. We'll gladly share the deck, as Gary said, and the information in PDF format. But when you start talking about prices showing signs of decline, prices stabilizing, but square footage isn't moving, what's the industry screaming we're facing this year? So lumber right now has returned to a more normal range on the price per 1,000 board feet, and it's projected using economists. I use tradingeconomics.com. By the way, it's a great website. If you ever want to use it, you can switch through commodities and hit the forecast tab, and it graphs it all for you. So that's a lot of what I'm showing here just for simplicity's sake. But the prices are expected to hold on lumber and stay fairly stable for the next 12 months. And they're already sitting. Actually, when I ran this report, it was sitting at 300. That day, it dropped to 287. So you're sitting at lumber and at raw commodity price, holding at numbers that look more traditional to pre-COVID era. Steel has a late cycle. So if you see these 21 and 22 highs in the steel, it shot around tremendously. That affects both carport, but it also affects the shed industry when you get into roofing, paneling, if you're steel paneling, and even other materials. It did see an uptick here, but it is holding and it is forecasted to decline over the next 12 months. That is a survey and a recent update, so that is already taken into account China reopening. So there's expectation that, that has a double-edged sword on steel prices, greater availability coming out of China, but greater demand against the Chinese economy. Gasoline, they don't track diesel quite the same way. I know in the industry, from a shipping standpoint, diesel is more indicative, but gas and diesel have a tendency to follow the same pattern. That is one of the commodity risks we think sits out there pretty heavily. The expectations is the gas is going to walk up fairly steadily throughout the year and head into summer and could start seeing peaks. So when you start looking at gas being a pressure on the economy, gasoline not only affects all of us in our day-to-day running our trucks and cars and equipment, but then that bites into the consumer's budget really heavy, really quickly, almost to the same equivalency that you see eggs in the milk car right now. I love all the memes with the eggs in the safe in the fridge, but gas kind of has even a bigger impact almost immediately. And we are seeing that we expect gas prices to come in significantly higher by the end of the year. Depending on where you sit on who's writing the check and who's signing the check and who's getting the check, if this can be good or bad news. Wage growth. So one of the top things in Gary's survey was talking about people worrying about employment. And one of the big ones is people are jumping jobs because they're making more money in new jobs or finding. And again, in a construction or manufacturing or even a commission-based sales entity, how do we look at that? Wage growth spiked over 11% in early 22, which is in this modern era the highest jump. But it is expected to grow slow to 8% by year end, but they're only expecting 2023 wage growth to be about 4%. So some of these just astronomical spikes in price per hour, price per, should start softening and slowing down as we think. With most of the people being in here being either employed or employers in a small business, that's a very relative thing. You start measuring that out when you look at consumer spending and you go, okay, gas is going up, I'm not going to grow as much wages, but what do we think the consumer is going to do, which ultimately is what drives the industry? Here's the thing I think people really, in my opinion, would focus on, which is Q1, Q2 of this year. There is potential of a decline in consumer spending in the early part of the year. That consumer spending is going to directly impact it. The concern from RTO National standpoint, when we sit here and we look at it, if we were to say a risk standpoint, we start talking about, well, what's our busiest time of the year? Typically, it's going to be spring selling season, March, April, May, depending on where you sit in the country. There's a nice spike in fall, but the shed industry in particular is always set heavy. Steel structures usually comes a little later in summer, but it's still a May, June industry. The biggest growth in consumer spending is expected to come at the end of the year. So you could see a decline in consumer spending through the first half, but it could make up for itself in the second half of the year. So you start thinking about stocking inventories, how businesses flow. Unemployment's been extremely low. That's also put pressure on the wages because you got really low employment. There's a big job demand. I'll reference this later. It is expected to start to increase, especially late in the year heading into 2024. Unemployment will start ratcheting up, which again, depending on which side of the coin you sit, that can be a good thing or a bad thing. As unemployment ratchets up, there's people out of work, there's more people to fill open jobs, so the demand comes down. It also puts and flattens out the wages. They all kind of flow together, how you think about them. But this is coming later in the year. Inflation rates expected to slow down by 6%. Again, a top 3 respondent survey question. What do you think it's going to do? It's expected to decline, but there's also this direct correlation. As inflation starts to go down, the interest rate increases start to soften and they hold at a more flat pattern through the year. There is somewhat an expectation, at least in this series of economists, and Trading Economics does a good job, I think, of kind of compiling mass industry data. Wall Street Journal published a simultaneous article going they expected rates to not decline through 24. So Trading Economics in their surveys came back and said they thought it could start to decrease. I think the big thing is everybody's fairly confident the rapid increases are going to slow. There will probably be several more increases, but of a lesser rate, but they'll start to stable and flatline with a possibility of a 24 softening. So you could see a lower cost. That does impact the consumer as it comes into other goods. But here's some stuff that we think is relevant. If you look at all the Fed funds rates and you go back through time and you're comparing Fed's fund rate in blue to the consumer price index, right now today we're still not there. The CPI is not softened enough against the federal funds rate to really say that they're done. So when you take back, especially if you followed Jerome Powell and kind of some of the things in his methodology as the Fed chairman, it's looking like they will still continue to raise them for a little bit more. The other big one that they're weighing in, which is kind of this series of Fed committee members, is the ratio of job openings to unemployment level. So again, trying to fill the roles and balance them out and also look at the CPI. There's a certain appetite for it that says we could be still looking at some rising interest rates a little further into the year than maybe the first glance says. And you're definitely not looking at any significant lowering. Here's the next one, and margin was another one brought up, and we think about profitability. The survey showed, and so did our data when you go back to the beginning, that there was growth year over year in unit sales, and I didn't put up revenue. But there is a concern that we may be seeing pressure against profitability. So here's I got some buddies in the room who go, Richard, sometimes will give you the downside. So there is a silver lining to it, and I'll get to the summary. But if you're looking at a business that says we could see Q1 and Q2 consumer prices and consumer spending start to drop, you see a continually rising gas price and holding or raising of interest rates, and you're looking at record inventory sitting on the ground heading into busy season with some indications that people are starting to discount to maintain volume and turn buildings, you do have a scenario there that says if dealers have a slow March and April, that you could see a resurgence of like the 2018 rain year price wars. All of a sudden I'm glutted with inventory, and I won't do it where I go, hey, how many people were in the business in 2018? Because you got a lot of people that haven't gone through that phase. For those of you that were there in 2018, it was a 100-year wet cycle for the whole U.S. And inventories really started stacking up, especially coming out of the May selling season. Now, the good news in those days, they were pre-sold, you just couldn't deliver them. But you're facing a similar scenario where you have these extremely high inventory numbers, a slightly tightened or nervous consumer, and your prices haven't started to decline and inflation is at least flat. So what does that mean? And you see that, so the gray areas are showing previous recessions. I won't get into the political debate of are we in a recession or not. You know, you can argue that just depending on how you want to define it. But we are sitting in a window right now that looks like it is showing itself that there is margin compression in manufacturing. As people are striving to take advantage of the sales, maintain their volume, and do the things, they are already starting to see margin compression. And again, if you look at the survey, it's told itself in the survey. People are going, is that an issue? I'm not trying to debate it, I'm just trying to confirm it. Gary goes, does the shed and carport industry represent what people are saying, and how would you document it? When you get into a couple of these reports, it is showing that people possibly are pushing bigger buildings with discounts, and they're already facing margin compression. They're coming off of record profits, possibly for 3 years, 2020, 21, and 22. 21 was somewhat compressed by a lack of inventory, so 21 was the biggest. But 22 mounted it past it from a unit standpoint, but you're seeing the margin compression kick in. Summaries and my disclaimer, these are as much my thoughts represented and somewhat by the group, but the positives for the upcoming year. Material prices have come down and are stabilizing. That's uniform, and if you go through the other graphs, we don't see anything that's really screaming, lumber's gonna go up, steel's gonna go up. The thing you gotta watch is gas. You know, diesel, fuel, transportation costs. Inflation is slowing down. The good news is other things are starting to slow down in their growth in pricing. I want to be careful. People are going, hey, eggs didn't get cheaper. No, we're just saying they're not going to go to $9 a dozen. They're going to hold where they are, probably through the first half of the year. Supply chain constraints are mostly gone. We can argue at this point there are still some, I know, micro items that are hard to get, but as a general rule, you can put your hands on most things and get it in a reasonable time, or you've adjusted from a just-in-time inventory supply to where you're starting to stock a greater supply to manage what your risks are. Consumer spending is expected to grow by year end. We at RTO National are still very optimistic that 2023 will be a better year. It'll be a bigger year and the company will grow. You may have to really work hard to get to that point in the second half of the year. Available stock inventories are high. If you're a manufacturer, you're going, that's dollars sitting out there that hasn't sold, and how old are they? If you're a retailer, you're going, woohoo, I got buildings to sell, you know. How many of you were selling buildings 24 months ago and you were pre-selling in 14, 18-week delivery cycles? Now all of a sudden the average lot's 35, 45 buildings sitting on the ground. So you should be able to turn and fulfill orders for the available consumer, but it will heighten the anticipation of that consumer's activity. Labor costs are stabilizing. That's probably still one of the big risks. I'm not saying the labor pool has increased, but at least the just raging rise in prices. You're not facing the fast food place down the road paying more for somebody doing French fries than they're paying for you to have them build sheds and carports. So that should start stabilizing. This one I'll kind of harp on. New technologies are bringing efficiency and scale. A lot of people do this. The restraints on production invested heavily in technology, methodologies, and better systems. We are starting to see the fruits of those investments show themselves. There are people walking around this show today that have automated assembly systems, walls, floors, transfers. They've invested in new roll forming equipment. They're building more materials. They're bringing things in. They bought other technologies and softwares. They've expanded into the CRM. All of these things impact who's selling, how they're selling, and how fast they're selling. So you've got this combination of the buyer's out there, but there's more competition. There's a ton of inventory. Who invested in the new tools, methodologies, and ideas to go find them? The risks. If spring should not be what some people are expecting it, traditional theory says they will have to start liquidating inventory somehow. The issue is when that inventory is already built sitting on the lot somewhere, there is by industry norm only one way to do it. And you start discounting. So that could put margins under pressure depending on what happens. Now, we've got some partners and some of them go, hey, it might be a great chance for me to go buy some inventory wholesale cheap and replenish myself coming out of my busy season. It presents opportunities both ways. It's just being aware of it. Gas and diesel fuel prices are expected to rise. We all experienced that a little over a year ago. Diesel shoots up $6 plus a gallon. All of a sudden your delivery radiuses get tight. You're fighting hard to win the customers. What does that do to my margin? What if all of a sudden I can't just, it was great when we had people waiting in line to buy sheds. Slapping a 10% fuel surcharge on a building was easy to do and get away with. When all of a sudden you're having to discount the building 10% just to get it sold, all of a sudden adjusting to that surcharge, the mechanism that was just used may not be quite as viable in the future as it was. Interest carrying costs will remain possible. We do have people that they did invest in technology and equipment, but they borrowed money to do it, and some of it's on variable rate. It could continue to get more and more expensive. Consolidation. This is one I've probably spent more money and time invested in conversations around this in the last 6 months than we expected. 2023 will most likely be good, and there will be more buildings sold. It is definitely my opinion and supported, I think, by the data that those buildings and the more buildings will be sold by fewer people. That the big will be bigger, and they may be seismically bigger. And we're seeing that movement throughout the industry, which will, again, you start looking at the investments in technology efficiency and who has the ability to fight through a price war. It will bring what we've been thinking would be a consolidation the industry was facing going into 2019. That honestly, the pandemic stayed and slowed. And now you're seeing outside capital investing into the industry. You're seeing non-traditional investment into the industry. You're seeing mass accumulation of retail and manufacturing footprint. And you're seeing a pretty large change in how it's being done. It doesn't mean that you can't fight it out at a local level and still be successful. You just have to be aware of what's out there. And then again, the risk, adoption and implementation of new technologies changing the competitive landscape. You may not be able to depend on I'll sell enough buildings to the people that live within 5 and 10 miles from me. You know, we've got entities and partners today now that are running, 500-mile delivery radiuses off of online platforms selling sheds and carports. It's just, what does your market look like and what does it have? So from a summary, 2023 should be a positive growth year overall. We do think it may come late in the year. We think margin growth may be harder to achieve this year. We think there are downward facing pressures on margin in particular that'll make it a little more difficult. Status quo of operation may not yield the previous results. I can do the hand survey on this one. How many people have used Facebook Marketplace and sold successfully on it for a couple of years now and have experienced a massive downturn of your success rate with Facebook Marketplace in the last 3 to 5 months? The market is changing. It's shifting back to Google Analytics, and you're having to go into pay-per-click and other avenues. You're having to find different ways to sell, and the people that get to those markets and platforms faster will find more customers, more effective, and will sell more. The consumer will remain resilient, but it may take more work in the first half of the year, especially. Again, everybody's going out and finding new ways to go find the customer. There's an exorbitant amount of inventory, and it's who gives them the best service, the best experience, and gets to them first and fastest will probably be the ones that win. Overweight inventories may lead to pricing pressure as spring winds down. From a rent-to-own company, lease purchase, finance company, one of our biggest concerns is bad behavior. There's a real concern. There's a lot of people that borrowed a lot of money and put a bunch of inventory out there, and if they don't have a big spring that they're expecting and almost demanding to cover the debts that they've amassed, that all of a sudden you may see some really interesting behaviors come May and June. Because when you get people with their back against the wall, you never know how they're going to respond. So we're going to be watching that really closely. I don't mind telling people we've seen more instances of dealer-initiated fraud in the platform in the last 90 days than we've seen in 3 years. And it's people already feeling stress against their own ability to service their debt. So just understanding that and being aware of it. Consolidation and scale may bring that same competitive. That's kind of a fast overview. That's economics, forward-looking trends, year-over-year growth. We do very much feel the year will be good. We think the first half of the year will tell the story. We think as you get late into summer, you have there could be good market opportunities. Everybody loves to see it, and I've heard people for the first time in some of the magazines are advertising, I'm looking for new dealers. Yep. None of us have ever seen manufacturers actually putting print and electronic ads hunting dealers. You always just went out and found the people. So, you're seeing new methodologies, but there could be opportunities that open up depending on who has a successful spring and who doesn't. There could be new lots, there could be equipment, there could be all kinds of things that could be purchased, and all of that will lead into a late summer and fall that says price escalation slow down, interest rates may soften, which if interest rates soften and don't go up, the stock market may very well run, which raises consumer sentiment. People are spending again, it could be a big fall. And we're thinking fall will be the decider for a lot of people for how good of a year it is. And then you'll have to just decide where you sit on the margin.